this afternoon. Thank you for joining us. I see we have about 50 participants. We just want to wait for a couple of minutes till we get a good number. Maybe when we get to 70, we can start. Thank you all for making time to join us this afternoon on a Friday. Okay, good morning, good afternoon again, everyone. Thank you for joining us this afternoon for the first in our webinar series organized by the Watchdog team and the Technology Innovation and Fintech practice of Watchdog. We thank you for joining us this afternoon as we begin a series, looking at, our knowledge exchange series where we share ideas and thoughts on those issues that are most critical to what fintechs face on a day-to-day basis. Today, we will be looking at AML and CFT issues. Specifically, we're looking at transaction reporting for fintechs under Nigeria's AML and CFT regime. Of course, the reason why we are looking at this topic is because not only is it topical at this time, but it came out of the focus groups sessions that we had, where we asked a number of fintech players what were the issues that were topical, that they were struggling with on a day-to-day basis as businesses. And top of the list was AML, CFT compliance, reporting obligations, and how they manage dealing with KYC issues, and everything around this critical aspect of compliance. And so we thought, why don't we, start our knowledge exchange series, first of many, around this issue that is affecting many people. And that's why today we're going to be looking at transaction reporting, for fintechs under Nigeria's AML and CFT regime. And just before I introduce the panelists who will be discussing the issues with us, I think perhaps what is most uppermost on everyone's mind when we talk about AML and CFT, in Nigeria today is the fact that Nigeria has just been grey-listed again very recently, and of course that has implications for us as a country. It means we need to take steps to rectify, those gaps, those deficiencies that have been identified by FATF in AML CFT regime. And when we talk about AML CFT, there are several players that sort of fit into that ecosystem. There are the businesses, the players, like fintechs, commercial banks, there are the regulators, the CBN, the law enforcement agencies, NFIU. So it's that whole ecosystem. Everyone has to come together to take those steps that we need to take to ensure that Nigeria doesn't go from the gray list to the black list, because even just being gray listed has implications, for the investing public, international investors. Nigeria is now moving into a season of transition where we are looking to, we jumpstart again our economy. And, the fewer barriers to entry we have, the less areas of concern for investors, the more attractive Nigeria will be, as an investment destination. And of course, the better it will be for everyone. So just to go straight into it, because we have a very limited time, I want to introduce the panel. The panelists will be discussing the issues with us today and helping us tease out the issues. Just for introduction, my name is Damilola Salah. I'm a partner at Olanu Ajayi, and I'm a partner in the technology, innovation, and fintech team of the firm. With us today, discussing the issues, is Mr. Dominic Henshaw. Dominic is an AML and CFT compliance officer with over 15 years experience, working for financial service and e-commerce institutions. His expertise cuts across compliance, fraud, operations, business strategy, risk management and mitigation, business processing, consulting, and audit. Over the years, Dominic has gained vast experience and expertise working across multiple countries in Africa. He has a proven history of providing superior leadership to teams and executive level management to ensure effective decision-making. Dominic comes with sterling qualifications. He obtained his bachelor's degree in economics from Babcock University and has a graduate degree in business administration and management from the University of Roehampton, and is a certified financial crime specialist as well as a certified anti-money laundering specialist. He currently serves as the head of compliance systems and regulatory affairs at Jumia. With Dominic today is Mobolaji Bameke. Mo joined Flutterwave as Chief Compliance Officer in 2019 from JP Morgan. Mo is responsible at Flutterwave for managing and scaling the business's global governance, risk, and compliance program, whilst ensuring effective risk management and regulatory compliance in all of Flutterwave's operating jurisdictions. Mo joined, as I said, from JP Morgan with over 10 years experience working in the financial services industry in various areas, including risk, control, and compliance roles in London, New York, with coverage over Europe, Middle East, and the African markets. Mo has studying qualifications as well. He has a master's degree in economics, accounting, and finance from the University of Bristol, UK, and has an advanced certificate in anti-money laundering from the International Compliance Association in the UK. Mo is a member of the Professional Risk Managers International Association and the International Compliance Association of the UK. Last but certainly not the least is, and I saved the best for last, Marcel. Marcel is a Nigerian lawyer called to about 10 years ago after graduating from the University of Nigeria. He has since his qualification built a successful legal career in the legal profession, specializing in commercial, criminal, and technology law. Currently, Marcel is the head of legal operations at Number, a fast-growing fintech company based in Nigeria. In this role, Marcel provides legal advice and guidance to company execs, ensuring compliance with regulatory requirements and best practices. Prior to joining Number, Marcel worked with a reputable law firm in Lagos and in Abuja, where he advised a wide array of clients on several legal issues, including corporate governance, high-level dispute resolution, and was involved in commercial litigation. Marcel is known for his exceptional legal skills, attention to detail, and the ability to deliver practical solutions to complex legal problems. He's a member of the NBA, Nigerian Bar Association, and regularly participates in industry events and conferences. Ladies and gentlemen, I give you Marcel Ume, Dominic Henshaw, and Mo Bameke as our panelists this afternoon. Moderating the panel this afternoon is my colleague, Kofo Toriola. Kofo is an associate with the Technology Innovation and Fintech team of Olanu Ajayi. And together, Kofo and I advise clients in the fintech space on extensive issues, including AML and CFT. I'm hoping that we'll have a robust discussion. Ladies and gentlemen, please put your comments in the Q&A box, and we'll take those as the session goes, and we look forward to an enjoyable session. Kofo, over to you. Thank you.
Thank you, Disa, and welcome once again to all our participants, and thank you to our panelists. In the interest of time, we'll dive right into the question and answer section. As Mr. Salau has said, please put your questions in the Q&A box, and we'll attend to it as the panel session is ongoing. So the first question I'll be asking our panelists will be an open question to everyone. just so that we, water the floor. So this is to Dominic, Mo, and Marcel. With respect to suspicious transaction filings, financial institutions are required to undertake 3 activities, namely monitoring, investigation, and reporting suspicious transactions to regulatory authorities. In your experience as compliance officers, what major challenges do your company face in transaction monitoring space? Also, are there any evolving trends that you foresee that make this difficult? These trends may be new trends in transaction laundering schemes, fraudulent chargebacks, and the likes. So just to repeat the question, it's are there any evolving trends that you foresee that's making transaction reporting difficult? What major challenges are your companies facing, in the transaction monitoring space? Okay, just anyone would like to jump on the question? This is for any of the panelists.
Maybe I can take a first stab at it. So I'm going to approach this in a different way, but I'll still build it up to your question in terms of the trends. As many of us are aware, we cannot talk about reporting without addressing the key elements that come before reporting. And if these elements are not well addressed, then the reporting compliance program will not succeed. Broadly speaking, I would say that the first element is the existence of the people that make up the compliance and the risk teams. The risk team defines the company's enterprise risk management framework, and this will cover all aspects of risk the company is exposed to, and also determine the company's risk tolerance. The compliance team, on the other hand, having adequate knowledge of the risk exposure of the company, and also having a better understanding of the regulatory requirements, will develop compliance policies and will form the backbone of the company's entire compliance program, covering the general AML, CFT, and CPF program, and specific policies that speaks to onboarding and reporting, monitoring, record keeping, and training. So like in my company, we have 2 levels. The first one being the general AML, CFT, CPF policy. Then we now have specific policies that speaks to this other compliance program. So these policies are then implemented and SOPs are created to serve as reference, because it's one thing for you to draft policies, is another thing for you to practicalize these policies. So of course, all this are possible with the board and the senior management setting the right tone on compliance program and understanding the risk environment and how it relates to the type of service the company offers. Now, going back to your question, let me approach this from a general standpoint, if you don't mind. One major challenge of effective monitoring and reporting program is the lack of support from the board and the senior management team. And this is why I said, let me approach this from a general term, because I'm not actually facing this in my company, but this is based on general observation, based on my interaction with other compliance officers. A company whose board and senior management do not set the right tone for compliance would definitely not have the adequate support from them, that's from the board and the management, to acquire the needed resources for an effective monitoring and reporting program. I've spoken to a couple of CCOs, and many of them complain about the lack of support from management and board. For example, I've heard of a situation where they said that they cannot procure compliance monitoring tools because of the cost of procurement. Another example is where they want to employ some compliance officers, but they couldn't do that because they didn't get approval from senior management because they're trying to save cost. So just imagine how the team will struggle and how ineffective the compliance program will be. This is why I consider this #1 challenge for an effective monitoring and reporting compliance program. And I strongly believe that CBN also has this understanding. And this is why it is clearly written in the 2022 regulation that the ultimate responsibility of AML, CFT, and CPF compliance lies on the board and the top management of the financial institution. And I guess this is why even when the auditors come from CBN, the first thing they always ask, apart from let's see your policies, they want to see the minutes of the board meeting to see if indeed the board was involved in the decision making in terms of approving the policies as well. The second issue I'll want to quickly mention is, and I feel that it affects many entities, is a misconception that the monitoring program is only performed by the compliance team. I always raise this during my training that I conduct for my business and my sales team. And I believe that, personally, I believe that monitoring is a collective action with compliance taking the lead and also being the consolidator, or let me say coordinator in this sense. It's like different people are looking out for the company from different angles. I guess this is why the whistleblower program applies to everyone and not just the compliance team. So the business, for example, should be very much involved in the process, since their goal is to generate revenue for the company through new leads. They also have access to track spikes in terms of revenue from their clients. For example, a PSSP merchant that records, let's say, an average of 5,000 transactions every month, and in 1 month generates like 20,000 transactions. This is obviously a sudden spike, and the relationship officer should reach out to the client to better understand the reason for this spike and communicate the feedback to the compliance team. Unfortunately, this is generally not the case. I've seen many situations whereby the compliance team is just left on their own and say, okay, you guys are in charge of monitoring. So anything that comes to monitoring is not our business. So it's, to me, I feel that this is the main and the second challenge compliance team faces in terms of having an effective and efficient monitoring and reporting challenge. I don't know, maybe other team members want to handle other challenges, but I'll come back again to discuss more on this.
Yeah, so just to chime in there. So I do agree with some of the challenges you have mentioned. Just to add a little bit of flavor to it, right, and taking it from a more technical perspective, right. One of the key challenges, right, when it comes to transaction monitoring, right, like my colleague has mentioned, is with the right framework in place, right, it's only at that time they're able to effectively monitor transactions, right, and generate the right results. But even when you're doing that, one of the key challenges is false positives, right? While you're, whatever tool you've got in place, whatever framework you've got in place, one of the key challenges from a technical perspective is false positives. The number of false positives and the ability to be able to, minimize those false positives. And we see that in the market. And if you don't have the right framework, if you don't have the right tool sets, right, you have that challenge within the market, and that can very quickly, evolve and increase the cost of monitoring, because you find that you're reviewing quite a lot of transactions, but what you are seeing is false positive, right, and that could impact your ability to report as well. The transaction monitoring space is how it evolves and how these bad actors are able to, find various ways of doing things or of evolving the way they perpetrate their activities, right? But it's only through collaboration, having the right systems in place and having the right framework and foundation in place that you're able to actually detect them and evolve your system to be able to stop them as well. And I think, we've seen that, quite recently, especially in Nigeria, where, there's this push for a cashless society, and you see a lot of transactions going online. The other key challenge I also wanted to mention is also, it's an industry challenge, right? Where we've seen very poor collaboration within participants within the industry, right? It is only through collaboration, only through operating as a network that we can effectively improve transaction monitoring and ability to detect and stop suspicious activity within the industry. There's one thing I say, we're only as good, every company is only as good as the weakest link. And if that link doesn't exist, then every company is at a disadvantage, because if you're very familiar with the industry, right, most of these bad actors are able to collaborate, and they usually operate, within the same network. It's a very big, massive chain. And if those of us within the industry are not connected, right, we'll be at a disadvantage right from the onset. So that collaboration needs to be stronger, and we've got a lot of work to do working with industry participants as well as our regulators, to ensure that we can have a good systemic collaboration within the industry and be able to share data within ourselves to ensure that we're able to mitigate this risk. And that forms, a key challenge even from a technical perspective.
Thank you very much.
Yes, I hope you can hear me, right?
Yes, you can.
Yes, just to add from what Mo and Dominic had said. So starting with the general observation, and this is not peculiar with my company, but it's more like a general observation, is that the management, right, mostly on fintechs, rather see the compliance team as the blockers in terms of business and numbers, right? And I think this is one of the biggest issue fintechs are having in relation to doing the whole tax, right? Then again, speaking particularly about the criminal enterprise, right? When you look at the suspicious transactions monitoring system, right? For instance, a good money launderer knows about regulatory threshold and pattern monitoring, right? And thus, in order to disguise his intention, can keep his transactions infrequent, or sometimes even carry out transactions on some inconsequential value, right? So we may need to understand that the purpose of transaction monitoring is not totally to prevent, but to mitigate to a large extent and reduce exposure of the financial systems to be exploited by criminals, right? So Dominic, or rather Mo, spoke about corroboration by parties, right, on the industry. I think this is very, very important, because if from my own personal investigation, I've seen that most of these criminal syndicates and money launderers, they have a huge international network. As fintechs and financial institutions are taking steps, going for trainings to kind of restrict access to money laundering and whatnot, these criminal people are intentionally setting up further plans, right? They relate with each other. You put a first security threshold, they break it down, they find ways to break down these thresholds. And when you look deeper, you would even see that some of these criminal urchins do attend several trainings to kind of penetrate the system. So when you keep doing this, and you just see that as you're progressing, they are intentionally trying to penetrate through your system. Another issue is transaction monitoring, for me, is quite reactive rather than proactive, right? Some of the measures of transaction monitoring is configuration of the system to flag transaction after it has taken place, right? There are some set of monitoring rules that will be more effective on a central database than passing the burden to individual organization. For example, layering of funds and its movements within the financial space would have most likely been conducted before the financial organizations involved even get around to reporting. The data gets analyzed and any reasonable action is taken to stop the process. So the problem here for me is that we need to set up strategies, right, to even forestall the transaction before it has happened. Because when we flag these transactions, the next thing we'll probably have to do is report them, right? But some of them have passed through, right? And in the fintech space right now, we know that the main business purpose of fintechs is seamless onboarding, right? So doing seamless onboarding, and the problem that I have noticed in on my own situation is social engineering, right? I have noticed on several occasions that what some of these money launderers do is that because of the seamless onboarding, you can download the app, sign up, and have an account that is based on a particular KYC threshold, right? What I've noticed is that some of these people go ahead to steal the identity of maybe the less privileged, or they buy the identity of the poor people by buying their BVN or whatnot, and they use this to create fraudulent accounts, right? So when they do this, they tend to max the transactions, right? They do these transactions, and when you get them, they abandon the account, buy another person's BVN, create another account. This becomes a trend. This is an evolving trend that I have currently noticed in the system, and internally as an industry, we also need to really look at it, right? While fintechs are doing all they can to prevent money laundering, it's every single time we take one step, the people that are doing the money laundering are also taking additional steps to curtail this. So we really, really need to foster our relationship based on industry practice and collaborate more. That is the only way we can say that we are 100% forestalling any money laundering or anything that goes on in our system, right? It becomes a real problem. Yeah.
Still on the
okay, all right.
Still on the people, just to follow up on what Marcel said. I believe we can all confidently say smurfing and structuring can never go away when it comes to method used by criminals to evade detection when it comes to money laundering. Some smurfs don't even know that they are being used to launder money. I mean, a good example is when we see money launderers using family and friends, telling them I need to send money to someone, but I don't want the person to know that I'm the owner of the funds. So probably let me send the money to your account, and you send it to the person. But at the back end, what they're actually doing is use them to launder money. And as long as this is being done, and the money being laundered is not associated to one person or a handful of people, then the laundering will always take place without detection. And I believe this is where tech comes in, and having a robust compliance tool, which is able to detect scenarios of like many-to-one and one-to-many, many-to-one or one-to-many scenarios. So this will help in terms of detecting this type of relationship. But if you don't have this robust tools, you always fall victim to your platform being used by these criminals.
Thank you very much. So what I hear from our panelists with respect to maybe major challenges or things that you're seeing that is sort of hampering suspicious transaction reporting is, lack of support from management. I think one key thing I heard Dominic say is that monitoring is everyone's business and not just the business of the compliance team. Everyone has a responsibility for monitoring. Also that the right framework and the right tool sets can also serve to help mitigate some of the challenges that arise from suspicious transaction monitoring. And there's also a need for industry collaboration among participants if we want to successfully, fight against some of the money laundering activities. And lastly, that transaction monitoring should be proactive and not reactive. And believing that if we adopt a proactive approach, then that will also reduce to the barest minimum some of the issues or incidences of money laundering. Thank you to our panelists. So just on the parts or just on the points that transaction monitoring should be proactive, this question is for Dominic. In your experience, what role do diligent KYC, and that is know your customer, and customer due diligence process play in aiding a financial institution's obligation to monitor and investigate suspicious transactions? And just a follow-up question to that, how can financial institutions strike a reasonable balance between compliance and regulatory requirements, as well as ease of onboarding customers in order to obtain relevant KYC information?
Okay, thanks, Kofo. This is indeed not an easy question, considering that entities are in business to make money, and straining the relationship with their partners and customers will negatively impact this objective. Before I go into what we can do to create this balance, I think I would like to start by saying that the best way to address this type of issue is by avoiding going into relationships with entities with questionable characters in the first place. And when I say questionable characters, I mean their antecedents, negative public information, and other observation. I know this is not going to sound easy, considering that you cannot really know the internal dealings of these partners. And simply because you classify them as good today doesn't mean that they can be bad tomorrow. Regardless of this, I will say the first thing is ensuring that your risk assessment processes are robust. And having a strong governance structure will also help. Fintechs and other organizations need to define the possible risk and determine their tolerance in terms of the risk level. An appropriate governing risk committee needs to be established as well. And its function will be primarily to review the risky entities and customers and take a decision whether you want to go into partnership with them or not. In other words, I would say that risk process should be factored into the onboarding process. For example, in my company, we have a 3-level risk matrix, low, medium, and high. And we also incorporate sanction screening and verification in our onboarding processes. And while the sanctions team has a 3-level of assessments, so if the screening does not generate any alert or false, or it generates a false positive, the case is closed at level 1. However, if it's a probable match, it goes to level 2 for further review. And if level 2 cannot close it, it goes to level 3, which is like a committee set up to review cases and make recommendation. Fortunately, this committee seeks to take final decision by assessing the risk that the entity is willing to take. We've done this many times, and as difficult as it may sound, I believe that the process has become seamless from our own part. Earlier when I mentioned verification, this is also one very important step to take. And I feel that it's better for you to be connected to the appropriate database so that you can identify key stakeholders. You also recall in the CBN guideline that was sent to the banks and the OFIs, I think sometime in January this year, on beneficial owners. I guess what CBN is also trying to do is to ensure that we onboard and we have relationship with entities that are reputable, and also customers that are of good standing. Now going to STR filings on customers and partners. Filing STRs and not straining customer or partner relationship is quite tricky. A compliance officer will always want to investigate further if they observe a suspicious activity. And this is quite a sensitive situation because you don't want to tip off the partner or the customer, since tipping off is illegal. So fortunately for us, CBN has made this provision in their AML CFT CPF regulation of 2022. According to CBN, the financial institution that suspects illicit activity should verify and identify the customer if it has not already been done. But if it has been done, they should report such customer immediately. However, can I go on?
Please go ahead.
Okay. However, CBN also made further clarification in the regulation that if the verification or investigation will tip off the customer, then the financial institution should not conduct further due diligence, but report the partner to the appropriate agencies. So the question is, should the entity or financial institution continue with such partner or customers that has been reported? In my opinion, it depends on a few factors, okay? And they should be guided by the risk tolerance of the entity. Personally, I would not recommend any financial institution continuing partnership with any customer or entities engaged in criminal activities, especially if it has been confirmed. For partners, a simple letter drafted by the legal team without pointing to specifics be sent to the partner to terminate the contract. I'm not a lawyer, but I believe that contracts should have a termination clause. So financial institution must ensure that any contract they have with their partner should not make it difficult to exit such relationship. For customers, financial institutions should have appropriate terms and conditions in place that allow them to end such relationship with customers involved in confirmed illicit activity. On the other hand, if STR was based on suspicion and not confirmed, then risk review needs to be conducted and decision taken. My humble recommendation is to avoid businesses with elements that will destroy the reputation of the company. And when it comes to KYC and CDD, which is part of the onboarding program, and is simply to verify the identity of the customer, this should be done at a risk level because, like based on your question, it is better to make an efficient and effective use of your limited resources. So what we do is, for publicly listed companies, we don't subject them to very high onboarding program. But when it comes to medium to high entities, we subject them to additional steps in terms of verifying who the stakeholders are, who the shareholders are, who the directors are, and things like that. And this also means that entities like betting company, which is regarded as very high risk, we classify those ones as a risky venture, and we do our due diligence to determine if we can onboard them or not. But the main thing is that the regulation of CBN actually clarifies this for all the fintechs. So if you are a publicly listed company, fintechs are advised not to conduct due diligence on the shareholders, for example. This is because the risk is low, the information is public, SEC has done their due diligence, and this helps to fast track the onboarding and also continue the business relationship with the entity. I won't say that it's easy for all financial institutions. For my company, we also get pushback from the companies that we onboard. And one of the things that we've done is to draft a reference document, which we share with these entities through our business team. And it's just to point to each request that we make, we try to bring like a correlation to the backing of the regulation. So if you're asking for A, we expect that there's a regulatory requirement that expects us to collect A from such a merchant. And this has really helped us to fast track the onboarding and also maintain good relationship with the clients. Also, lastly, I would just want to quickly touch upon the CBN regulation and recommendation from intergovernmental agencies like FATF. They're all meant to protect the ever-growing complexity, to protect the fintechs against the ever-growing complexity of the methods used. And I guess Mo also touched on this earlier on. So by abiding by this regulation, what we're just trying to do is to ensure that our platforms are not being used to perpetrate or to promote money laundering, financial or other financial crime. So 3 things. Just number 1, we try to be clear on the requirements with all the customers and the entities. Number 2, we try to provide explanation on the rationale for all the requirements that we're making, or that we are giving to the merchant or our customers. And number 3, we try to digitalize the onboarding process by avoiding the back and forth that will really make the relationship kind of strained with the customer. So we try to make the process easy for them. So I know it can be frustrating, but if we are to blame anyone, we shouldn't blame the regulator in terms of the ever-growing requirement that they are putting out in their regulation, but we should kind of blame the criminals, because they are the ones that are trying to make our job very difficult. Kofo.
Thank you very much for that robust response. And I know that you said you were not a lawyer, but the recommendation you gave about terminating the contract was very apt. So maybe we'll confer honorary legal certificate. Thank you so much for your response. My next question goes to Marcel. And Marcel, when you were speaking earlier, you had spoken about collaboration among industry participants with respect to tackling, the challenges of suspicious transaction reporting. I also know that there's been talks about Nigerian fintechs teaming up to create data sharing initiatives to mitigate and prevent the occurrence of fraud incidents by sharing data. So in your opinion, what are some of the advantages to implementing this data sharing initiative, and what do you envisage as some stumbling blocks to the actualization of this initiative?
Okay, thank you very much for that question. So the sharing of data will always be to the benefits of companies, right? As data is knowledge, and this is known by everyone, right? Where today NIBS serves a platform for reporting fraud-related incidents, the collection of this data acts as a sort of repository of fraud, right? For all the Nigerian financial system. So some of the benefits I can see about sharing data, in my opinion, right, would be that this will keep fintechs up to date on the latest fraud method and trends. For example, for me, in my own situation, I know that social engineering is like the latest trend right now. Social engineering is one of the latest trend. So another benefit could be it allows for more in-depth analysis and decision making, right? It will also allow fintechs to know what areas of their system needs to be strengthened. For example, if I get the data from Mo's team, when I look at it, I will look at what we are doing. We can put something together, right? Again, it creates efficiency and accuracy within the system. And I think the final benefit for me would be that it creates new opportunities for data analysis, right? When you bring all the data together and analyze this, you will be able to see where we need to make an improvement and where we also need to soft pedal on. Because whether you like it or not, in my opinion, I think these high-level money launderers share data at all levels, right? And if they are corroborating more than us that are the financial institution, I think that is the reason why sometimes some of them prosper in certain systems. But again, there are stumbling blocks, right? And it's funny that accuracy of the information, right? Somebody's getting information and data from his own company. You're not necessarily sure that this data is correct, right? Which can be a problem. It may be correct, it may not, again, be correct, right? Another issue are obviously our data protection laws, right? Ironically, can also be seen as a stumbling block to this kind of initiative. Then again, the costs required to run such an initiative might also present a challenge. Such an initiative would require sufficient network and bandwidth speeds with minimal down times. But in my opinion, right, sharing data is very important within the financial space. Yes.
Thank you very much. So what I hear you say is, regardless of some of the issues you had raised, such as accuracy of information and data protection, it's still a welcome initiative, and you think that once implemented, it will help with, the anti-money laundering initiatives. Thank you so much. My next question goes to Mo, and I'm just going to piggyback on what Dominic had said earlier as one of the challenges to suspicious transaction reporting, which was with respect to the costs of implementing some software and some solutions. In light of this, right, so Mo, I was going to ask, so financial institutions are increasingly faced with, large volumes of suspicious transactions and alerts generated by the monitoring system. And, in response to some of these alerts, right, it is often required that financial institutions have resources to investigate these alerts. But the downside to, this having resource is the cost implication for implementing some of these resources and framework. So in your experience, and maybe drawing from your experience in Flutterwave particularly, how has Flutterwave, managed to reduce costs while still maintaining an effective risk management or risk compliance software or initiative in place? I'm sure a lot of companies will be looking forward to that.
Yeah, and thanks for that. And what we do basically is a collaboration or a consolidation of all the things that my colleagues here have mentioned, Dominic, Marcel. The first thing first, right, is to have the right framework, right? Is to have the right compliance and risk management framework. That is, you have a robust customer due diligence process, a robust sanction screening and watch list screening and transaction screening process, and leveraging the right tools for these two elements of the program, having a right transaction monitoring, AML monitoring, fraud monitoring process and framework in place, having your right regulatory reporting in place, having the right policy, ensuring that your policies and procedures are robust and touch every element of your program, and everyone that is within your risk of compliance team know what they're doing at every particular point, having the right and robust training for your staff, the right risk assessment, the right governance, right? Having all of these elements robust and solid within your program, right, is the first thing to ensure that you're able to, mitigate risk and stay on top of transaction monitoring, stay on top of ICR filing, and eventually reduce cost, right? And obviously on top of that, like we mentioned before, is ensuring that you have the right board buy-in, right? For ensuring that all of your programs have the right and appropriate resources to be able to operate effectively, right? So in addition to that, right, one thing that's also very important, right, is also ensuring that where possible, obviously not all organizations are able to do this, but we've been able to implement this in Flutterwave, is having the right enterprise risk management framework in place that encompasses your 3 lines of defense, right? Your first line of defense, which is every team or every team or department within your organization, right? And where you're even able to resource is aligning risk resources to them to ensure that from a first line perspective, they're able to identify risk or suspicious activity, right from the onset, before they sometimes even get into your systems, or you're able to even establish a relationship with them, right? So that is your tech team, your ops team, your customer service team, all acting as the first line of defense. And when you can resource, even attaching, risk operations to each and every of those lines to ensure that in the first line of defense, you are able to identify suspicious activity, right? Secondly is also having that second line of defense, which could be your risk strategy, your compliance, and so on, where they are driving the strategy from the organization, right from the type of tool you use, how governance is set, how you onboard, and so on, right? How your overarching strategy or your overarching compliance program or risk management program is working to support every line of business, right? And then obviously you can have your third line of defense, which could be your internal audit or external audit, to always help you validate independently or internally, right, what your process looks like, what your procedures look like, and ensuring that you're operating in alignment with leading practices. Having all of this framework in place is very important to be able to one, effectively identify suspicious activity and eventually reduce your cost, right? From a monitoring perspective as well, and managing your compliance program. From a portfolio perspective, one of the things we've done, right, to also reduce operational costs, in addition to what I just mentioned, is leveraging new tools, right? Always in the market and trying to understand what our transaction patterns are like and what are the tools that we've got in the market, that can help us reduce, and effectively identify suspicious activity right from the onset, right? Even before they get into our system, and even if they're able to get into our system, being able to minimize or be able to identify it, very quickly, right? Also eventually reducing false positive, right? Like I mentioned earlier. So, for example, one of the things we've been doing is leveraging AI tools, right? Tools that take thousands of attributes, right, from the customer from the onset, from the onboarding, from the screening, from the transactions, and being able to determine, whether there's something out of the ordinary going on. In addition to this, part of the AI tools that we're using, we've been able to leverage, also have what we call the network effect, right? Being able to take data points outside of Flutterwave itself and match it to be able to see whether there's any suspicious activity going on, and then we take all that information and we review it to determine whether we're able to file suspicious activity, ensure, and also always evaluating, right, to ensure that false positive are minimum, and when we need to file, we are filing as well effectively, right? Yeah, so those are some of the things, that we do from a Flutterwave perspective to reduce cost and stay on top of our obligations, right? And try not, stay on top of our obligations from a compliance or suspicious activity reporting perspective as well, And also one last thing to mention is, one thing we do as well is ensuring that our program, like I think I mentioned it earlier when I was talking about third line of defense, is ensuring that our program is regularly reviewed, right, by external auditors, by external assessors, to ensure and benchmark us, leading practices globally, right? Because sometimes when you're developing all of these things internally, you might not necessarily see where the gaps are. You bring somebody with a fresh pair of eyes that have done it globally, the best thing within the industry, to help you review, identify gaps, and you can work with them to remediate any gaps, and ensuring that what you're doing is always at the top notch. And that also comes with collaboration, right? We also collaborate with with other folks, banks, fintechs within the industry, to see what they're doing and try to benchmark and learn from them, and see how we can also use it to enhance our program, basically by learning and sharing information. In the interest of time, I won't go any further. Thank you.
Well, you've done justice to that question. Thank you very much. And in the interest of time, we will move very quickly to the Q&A. We have about 5 to 6 questions. And just to say that if you have a question, please put it in the Q&A box. So Mo, I know you just spoke, but this question touches on something you just spoke about, especially on the false positives and the AI-based. So Theophilus is asking, it says that false positives seem to be a problem with configuration and customer profiles, and it appears that AI-based monitoring tools help reduce the likelihood of its occurrence. But in your experience, what is the disposition of the CBN to tools like this, especially given the black box problem with AI deployment in financial crime compliance?
Yeah, so that's a very good point. I mentioned about false positive earlier, right? Sometimes it's almost impossible impossible not to have false positive, is also reducing it. The key, what you need to focus on is reducing it to the barest minimum. AI tools also generate false positives, right? But irrespective of that, when you deploy AI tools, right, it is very important that you review on a consistent basis the decisioning of those AI tools, right? And that's the area. When you're using AI tools, is one of the areas that CBN will also ask you, are you reviewing the output of those AI tools? Even if you think that it is reducing because one of the things I've seen in the industry is when you have AI tools, people don't review the output or the decisions that are being made by those AI tools, right? And look at where you could effectively even file suspicious activity, or where the errors might be coming in, or the negative decisions that those AI tools are doing. So it's very important that, we, or whoever is managing the system, continuously and consistently review all of the decisioning of the AI tools. It's also very important that, in terms of the tooling that you're using, you're also communicating with your regulators. You're also, evaluating the data that is being fed through all of those AI tools, and there's continuous tuning of the AI tools and collaboration with whoever, has built those AI tools to ensure that, you're not missing anything, within the management of your AI tool to be able to be effective in your transaction monitoring and managing compliance program. I've seen regulators some regulators actually have seen, where they have been a little bit worried about, what AI tools are doing, because sometimes, depending on the one you're using, you might not necessarily see or understand exactly how they operate, because they all hide under the guise of AI tool. But it's very important that for your AI tool, you have the appropriate governance that understands, that manages, that looks at data in and out of that AI, of how that AI tool operates.
Yeah. Thank you very much. And I'm going to apologize if you sent in questions and we're unable to take it. It's because, we're running out of time. And I'd also like to crave the indulgence of our panelists and participants to shoot 10 minutes, just 10 minutes extra, so that we can take 2 more questions, if you do not mind. So just very quickly, this question is for Dominic. Someone is asking that what are some risk measures to put in place, especially in relation to compliance, when building a fintech product? Just if there's just some things you can run over very quickly, especially as it relates to onboarding of customers and KYC.
Okay, I will say that when it comes to onboarding and KYC, the best approach is to first of all understand what the regulator permits. You need to understand the risk classification of the people you're onboarding, or the entities you're onboarding. You want to classify them as low risk. What is the reason, or what are your reasons for classifying such entity as low risk? If it's medium, you want to understand that as well. Then you also want to have a better insight into your risk tolerance. What can you as a company tolerate? Some companies will tell you they cannot onboard betting companies because of the risk that comes with that type of service. And I guess even the card scheme, MasterCard and Visa card, they require acquirers to pay extra fees to onboard when you're onboarding high-risk entities. So you want to ensure that your company has that tolerance to accommodate that type of business being onboarded. Now, another thing you want to also consider during your onboarding program is, I think Mo mentioned this earlier, your sanction screening. There's also this misconception that when you onboard a company or a customer, then that's the end of it. But onboarding is a continuous thing. You want to have like its life cycle for your customers and the entities that you are partnering with. Some companies do a 1-year life cycle. Some do 2 to 3 years. Some even go as far as triggering recertification when the ID of a principal stakeholder expires. So it depends on the risk assessment of your risk assessment, and also the tolerance, and also understanding the nature of the market that you're operating in. For example, in a remittance company, you know very well that fraudsters are always involved in what we call the online romance scam. And so you want to identify this type of risk, and then you put in place some risk measures, like setting a rule-based approach, like saying that if you send more than X amount of funds to someone you're not related to, let this trigger an investigation. So it depends on the type of service. It depends on the company's risk tolerance, and I must say that everything that is done should be guided by the regulatory requirements, so that even when there are issues and you report, the company will not be found wanting.
Thank you very much. Thank you. And this is our last question for today, and I'm going to throw it to Marcel. Victor wants to know that in transaction monitoring, what are the best tools to mitigate fraudulent activities to the barest minimum?
Okay, so like I said before, right, transaction monitoring is very, very dicey, right? In a situation where you're performing transaction monitoring, some of these money launderers are very, very quick at noticing what the regulatory thresholds are. For example, at each KYC level, they monitor the transaction level. So if, for example, if you say that the KYC level is level 1 and transaction should be for like 50,000, these people, what they now do is that they break down the transaction into thresholds, right? 50,000, they can now be doing 20,000, 10,000. So the best thing to start from the beginning, what we have to do is transaction monitoring SOP, right? When onboarding clients, you put in place thresholds, right? Then the best thing that is being used now is you have an AI-based monitoring system that reduces the risk to the barest minimum. Because again, when we as humans do our bits, the AI monitoring system is the best at this state to reduce the possible risk, right? So that is the best to inbuilt spot checks within the system. Yes.
Thank you very much.
So just to, sorry, let me quickly add to that. And this also plays back to the first question around AI tools, right? It is very important that as you deploy AI tools, that you do not forget AML monitoring. And AML monitoring is very different from transaction monitoring. You know, I've heard, I've spoken to a lot of people and they tend to mix it up. Transaction monitoring looks at short bursts, short runs within shorter period. And this is where most of the AI is also focus on, right? Network effects, what has the person done, recently, maybe in the past sometimes. Well, your AML monitoring is very important that, businesses, firms, financial institutions also focus on AML monitoring, which is best done manually, right? And this is looking at longer patterns, long-term behaviors of your customer, long-term behaviors of transactions. What has the person done over the last year, over the last 2 years compared to what they're doing now, as an example? So you are taking bigger data and analyzing it to check if any suspicious activities have gone wrong, right? Because like one of my colleagues mentioned, sometimes, right, it's, because they're so smart, but not necessarily, or your system are not able to pick it up right there, right now. When you look at the data over a longer period, new trends might come up, which will need to be reported. So it's very important that as we go into the period of automation, there's a separation of transaction monitoring from AML monitoring that looks at long-term information, bigger data, and so on, right? It's very important to make that distinction, especially as to deploy AI tools.
Thank you.
Yes, just to further address that, right? So according to the situation and from what Mo has said, right, when you deploy the AI tools will limit based on what is programmed to do, right? But again, these money launderers can find a way to, just like I said before, to reduce the threshold in terms of the transactions, right? For example, you've programmed the AI to monitor a certain transaction based on a particular figure, right? But these people are smart enough to know that this is what the AI tool is looking for. Why can't we do it in such a way that it can still pass through and the AI tool will not pick it up? So having to do the normal physical transaction monitoring by human beings will see a way to gather all the data, collaborate them, and pick out those transactions that are frequently put through at that barest minimum that the AI may not be able to pick up. Yeah, just to add to that.
All right, thank you so much. I would hand over to my colleague Adenike at the moment to take this further.
Thank you very much, Kofo. And on behalf of the Olaniwan Ajayi LP team, I just want to say a big thank you to our panelists, to our participants, to management and staff of Olaniwan Ajayi on the call. You've been with us from the beginning and you're here even now. I see a hand raised. I'll just assume that might be an error. However, if you still have questions, I know that we were not able to treat every single question. However, if you still have questions, please keep dropping your questions in the Q&A box. We are going to forward all the questions that were not able to be answered to the panelists, and we'll get them to give their feedback via email. Because of the registration process, I know we have the contact of each of our participants and we'll be able to get back to you. Thank you very much. To the panelists in particular, we at the FinTech team in Olaniwan Ajayi have worked with you. It's been a pleasure, and we're so grateful that you've taken our time to be with us today, to share your knowledge with us. Personally, it's been very engaging, very worthwhile. And more importantly, we took this approach because we didn't just want it to be a bunch of lawyers rehashing what the provision of the law is on this issue. It was very important for us to get, how the experts actually feel about these issues and to invite other experts to learn, about what's being done from one of the biggest players in the industry. We don't take this for granted at all. We really appreciate you. To the participants, thank you for being here. And I hope that everyone enjoys the rest of their day and they have a good weekend. Thank you very much.
Thank you.
Thank you, everyone. Thank you.
Thank you, everyone.
Thank you, panelists. Thank you, attendees. Thank you all. Have a good day. Bye.